So increasing interest rates seem to be happening a lot sooner than expected. So in today's episode, I want to take a quick look at 3 companies that I believe will do well during a high interest rate environment. And these are companies that are going to have high cash flow from operations, that are going to have a very strong balance sheet, and that are going to be in a market that I believe can increase their overall prices without a huge impact to the business. And for each of these companies, we're going to take a quick look at future growth. We're going to look at their balance sheet. More importantly, we're going to take a quick look at valuation metrics to see where they're sitting compared to where they have been in the past. The first company we are going to take a look at is Activision, and to me, I might be a bit biased, but I do believe the video game industry is one that will do well as this kind of interest rates continue to talk, because most of these top video game companies are very high in earnings. They have very high cash flow margins. And video games right now are one of the cheapest ways consumers get some form of joy experience right now. All right, so like I mentioned, we're taking a look at Activision. You might know them from some of their big players like Call of Duty, World of Warcraft, the Blizzard timeframe, or even Candy Crush in the mobile world. Activision right now is traded under the Nasdaq as ticker ATVI. It's currently sitting at $94.06. It was down about 2% today, and we can take a look from its 52-week high closing. The stock is down about 9.3%. This is definitely not one that has taken much of a big hit, and mainly because other investors kind of foresee that, hey, the gaming industry is one that might do well during this overall talks of higher interest rates. Activision is expected to grow 7.7% on average for the next 3 to 5 years, so it's a moderate growth stock right now, what I would consider. But here's what I'm really liking, right? They're profitable in earnings, they're positive in cash flow from operations. They also pay a small dividend at the moment, not something ridiculous that would really affect the overall cash flow for the company. And before we take a look at their balance sheet, make sure to hit the subscribe button, the thumbs up. It really does help with the overall channel. And let's take a quick listen to today's sponsor, a great reason why I'm able to provide so much content to you guys for free. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services the Fool offers. Through the Motley Fool Stock Advisor services, you get access to a ton of expert stock picks. Every month you'll get 2 new picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done amazing returns. If growing your money is something you'd like to do more of this year, you can visit fool.com/Jose Najarro or click on the link below for access to my special offer and decide if the Stock Advisor is right for you. Thanks again to the Motley Fool, and now onto today's video. And if we take a quick look at their balance sheet, they have about $9.5 billion in cash and short-term investments and about $3.3 billion in debt. So this is a company that I believe will do very well during high interest rates environment. If we take a look at their most recent earnings, their Activision segment revenue grew 72% compared to the same time last year, driven by their Call of Duty platform. The Blizzard segment grew 7% year over year, led by strong growth in the Warcraft franchise, and their King segment revenue reached a new record, growing 22% year over year, driven by strong growth in their Candy Crush. So we can see they're hitting everything from the mobile market, the PC market, the console market, and they're also hitting that freemium market where you play the games for free and just buy skins, just buy loot boxes, and it's doing really well for the company. Not only was their revenue growth impressive, but their operating cash flow was super impressive. They had about $844 million in operating cash flow compared to $148 million same time last year. So this is definitely a company I would enjoy having during higher interest rate stocks, high cash flow from operations, strong balance sheet, and still seeing strong revenue in its market. All right, so the second company we are going to take a look at is Salesforce, and this is the customer relations management company. I have talked about Salesforce in the past. So Salesforce right now is traded under the New York Stock Exchange as ticker CRM. It's currently sitting at $242.39 and was down about 0.1% for the day, so not much movement here. From its 52-week high, the stock has definitely seen quite a correction. It's down about 13.82%, and it currently has a market cap of $224.45 billion. Salesforce is expected to grow 15.8% on average for the next 2 to 5 years, so we still see a growth company here. I'm not giving you any boring companies at all. They're profitable in earnings, but more importantly, they're positive in cash flow from operations. If we take a quick look at their balance sheet, they have about $15 billion in cash and short-term investments, and about $2.7 billion in debt. Again, another strong balance sheet, and this is what we like to see during high interest rate talks. If we take a look at their most recent earnings, first quarter revenues were $5.96 billion. That was up 23% compared to the same time last year. The most important thing I really want to see is that operating cash flow growth. It is now $3.23 billion for this first quarter, and that is up 74% compared to the same time last year. For the second quarter, they expect revenue guidance of about $6.22 billion, which is up 21% compared to prior year. So we can see still substantial growth for this company. The final company we're going to take a look at is Google, and I don't really think I need to explain Google much, but hey, if you don't know, just go to google.com. Right now, the stock price is traded under the NASDAQ as ticker GOOGL. It's currently Alphabet, right? I always say Google, but it's really Alphabet company. I make that mistake. It's currently sitting at $2,415. And we're going to see, right? This company is right now sitting at almost its all-time high. So you're going to be like, Jose, why are you taking a look at this company? Salesforce also, that one has gone up dramatically in the past few weeks. Why are we looking at these companies? And that's why we're going to take a quick look at their valuation metrics later on to see why they're not really that expensive. So Google right now is expected to grow 14.2% on average for the next 3 to 5 years. This is another positive in earnings company, but more importantly, they're positive in cash flow from operations. If we take a quick look at their financial health, Google is probably one of my favorites. They have about $135 billion in cash. Yes, cash. And they have about $13.8 billion in debt. This balance sheet is amazing and one I wouldn't mind holding during higher interest rates. If we take a look at their most recent earnings, their revenues grew 34% compared to the same time last year. They're seeing strong growth driven by their overall advertisement business, right? That's where Google makes most of its money. YouTube ads keeps making that money, and hopefully one day I can see some of that cash really into my portfolio. At the moment, I'm gonna keep grinding it out with these videos. So Google is definitely another position I wouldn't mind having in my portfolio. Now let's take a quick look at the technicals. First, let's start off with Activision. The stock price right now, looking at my moving average, is not overextended from a short-term or medium-term average. So that's sitting pretty good. It's definitely sitting at a nice volume area. If we take a look at Salesforce CRM is definitely a bit overextended from its short-term and medium-term moving average. This is not something bad. It just tells me, hey, there's a little bit risk and the possibility that this stock might see a small pull down. Just a higher risk, not a guaranteed. Again, we're going to take a quick look at valuations to kind of see how they're looking in the compared to their valuation metrics. Now, if we take a look at Google, this one is definitely overextended. You're going to be like, Jose, why the freak are you showing me this company right now? Look at that overextension from its short-term and its medium-term average. Yes, I do want to say, I do believe there is a higher risk on Google, but let me show why I really mentioned these companies. Here, I'm taking a look at their valuation metrics, and I'm taking a look at price compared to free cash flow. And first, let's start off with Activision. Activision right now is sitting at a ratio of about 25.58. And we can see this is cheaper than it's been since early 2020. And we can see this value is actually not that crazy compared to where it was in 2018 and 2019. So Activision is still looking pretty attractive, even though it's seen those crazy run up in stock prices. Now we take a look at Salesforce. Salesforce is definitely going to trick you guys a bit. Sitting at a ratio of about 40.43. Remember, I'm looking at price to free cash flow. Right now is a lot cheaper than it was earlier this year, even though the stock price is a lot higher than it was. And that's the great thing about how companies continue to improve their overall fundamentals, and sometimes the price doesn't really reflect it. And this ratio of 40.43 seems to be where this company was at in 2018 and even sometime in 2019. So again, not that overextended in price. The final one we're going to take a look at is Google. Even though Alphabet, the stock price is at its all-time highs, its price to free cash flow ratio is cheaper than where it's been at in 2021 and even the second half of 2020. And it's currently sitting at levels I want to see it's on its average price. So even though Google's price is at all-time highs, it doesn't seem overvalued at the moment. Again, all these stock prices can see huge volatilities and they can continue to go down, but I do believe a good portion of the risk has been eliminated for some of them, especially looking at these valuation metrics. Now, my overall thoughts. I do enjoy all three companies, and that's why I do present them in this video. In forms of market-wise, I do believe the gaming market is one that's going to do pretty well. during talks of higher interest rates, and I really enjoy it because this is a market I feel not many investors try to get into. I feel like they think it's boring, and all power to them, but I do believe this is a strong market. Salesforce and Alphabet are also looking pretty attractive. So I hope you guys enjoyed today's episode. Take care, have a good night, and see you next time.